Hello, everyone. This is Royston from NAOF. So most of you would probably know me by now. I'm actually the founder as well as chief editor at New Academy of Finance, or NAOF for short. So today, I'm very happy to have Nicholas here with me. Nicholas, would you like to kind of like give a very quick introduction of yourself?
Hi, Royston. Thank you so much, actually, for having me again. Thank you. I think you invited me to talk about a topic which I'm so passionate about, inflation. I know we vented about this many times over coffee. It's a privilege to be able to do this online and to share with your audience. Thank you.
All right. Okay. So thanks, Nicholas. So today, we are going to talk specifically about inflation, which is actually a pretty hot topic right now. Everybody is kind of like talking about inflation to a certain degree. So we want to focus on three main points today. What exactly is inflation, and how does inflation actually affects the man in the street? So that will be our first topic. And after that, we want to talk about whether or not we should be concerned about inflation today, because that has been the talk of the town actually for the longest of time, for the last decade, since the US government actually started printing money like crazy post GFC. But how different it is now versus the last decade. So that's something that we'll cover, or Nick specifically will cover on that. And last but not least, we will want to wrap up this whole inflation topic with regards to introducing some investment assets to actually beat inflation. Okay, so
Okay, man.
how's that sounds to you, Nicholas?
No, let's jump in, man.
All right, so let's get started immediately. So just to bring to your point, right, because inflation is actually a pretty big word that most people at this point of time might still be a bit confused at the end of the day. So let me just use very simple terminologies and illustrations to actually show you how inflation actually matters to people like us, men in the street. So let's take, for example, this chart. All right, let's take, for example, this chart, which actually shows the price of sliced bacon as well as pasta. So this is actually an infographics being taken from Visual Capitalist. It actually shows that the sliced bacon price today, if you had bought it back in 2007, it will actually cost you $3.66 per pound. Pasta is roughly about 88 cents per pound. Fast forward a decade later, in 2017, 10 years later, and that figure have actually increased from 366 to 5.79. So that's actually a pretty drastic 58% increment over the last decade. And same with pasta, that's a 45% increment. So to put it very simple in a nutshell, in the past, it used to cost you so much cheaper to buy the same amount of grocery, for example. Now, in today's dollars, it's going to cost you much more. So that is the effect of inflation, and it is something that is happening quietly behind us, something that is just kind of like creeping up without us really noticing much difference. So it's actually also termed as a silent killer, especially today if you are looking to retire. You realize that $1 million that is required today for retirement might not be sufficient if you are looking to retire in 10 or 20 years time. That because solely the impact of inflation. So I hope that that is just a very simple illustration using some of these grocery products as an illustration. But how about talking about on the investing concept? So a lot of you guys tend to save, right? Put your money into the saving banks, the safety of your savings banks, and assume that at the end of the day, your money is kept safe, and you are basically doing a good job in terms of increasing your wealth. But very honest, that actually is not the best way. All right. And this is basically what is going to happen. So assuming that today, if you have money to actually buy a Honda car, right? A Honda car in today's Singapore context is probably going to cost you like $80,000, $90,000 at least, at least. So imagine what is going to happen if you decide to take this $80,000, $90,000 and put it under your mattress, all right? And you forgot about it. And after 30 years, basically, you can afford a bicycle, all right? You can afford to buy a bicycle with your $80,000, $90,000 kept under your pillow or your mattress for that duration. All right, I might be a little bit extreme in terms of that, but you get the kind of point, right, that I'm trying to make, that because of the fact of inflation, $80,000, $90,000 in today's term is not going to be worth much in 30, 40 years time. And the amount of purchasing power that you have at that point of time is going to be pretty low. So what happens if you actually invest that $80,000, $90,000 into like certificate of deposits or bonds that's probably yielding you 2-3%? That's probably in line with the kind of long-term inflation rate. At the end of the day, your $80,000 can probably get you another Honda car, a similar Honda car. All right. But if you actually invest it wisely in the stock market, that potential $80,000, $90,000 that you can previously purchase a Honda car could ultimately result in you buying a Maserati car if you actually partake in the stock market. That is why a lot of times people say that you should not be just purely saving. It's good to have a habit to save, but at the end of the day, you need to make your money work harder for you. And essentially, you need to generate the kind of returns that at least beat inflation. If not, your purchasing power would be substantially curtailed. All right. And if today you can actually invest wisely into the stock market, this is the kind of potential that you might have moving forward. All right. So that's from my perspective. All right. So I'm not sure what does Nick have to add to that.
I think all very good points. I just want to check something with you. How is your Maserati doing?
I don't have Maserati.
Oh, okay. Okay, so you have something higher level.
I think you have got the wrong Royston.
No, okay, interesting. Okay, because I have many friends who do a lot of biking, and I tell you, I mean, the amount of money they pay for their bikes are just incredible. But can we just go back to the last page? Yep. And on that you just show, because this is really interesting. I mean, I'm just curious to see where we would be today. 2 years, 3 years from 2017. Especially when 50% in 10 years. I think the last 3 years, I think things may be a bit more acute now. But anyway, I mean, as Royston has mentioned, I just want to share. I got some slides on my phone, and I want to share. What I'd like to be talking about is specifically about how inflation affects the stock market, affect companies in the stock market. I mean, I'm a market person, so inevitably, I know Royston has brought up a good few points from a consumer point of view, but they're all interrelated now, because at the end of it all, inflation is actually a big moving force where stock markets are concerned, over and above our cost of living now. Okay, can I just take over for a quick one?
No problem, man. Take over, Nick.
Okay, let me just. Okay, I just want to bring up 4 points and maybe a few slides to substantiate the 4 points. Okay, first of all, I think that these are some key 4 reasons why we think that this is higher than expected. Inflation is higher than expected. The word that's in the buzzword that's in the market right now is a word called transitory, because this is where the Fed thinks inflation with the high rate that we had 2 weeks ago is only transitory, and it will sort of normalize or level out in the next 2 weeks or so. Okay. Whether that happens or not, I do not know. I mean, nobody knows that. Okay, but I like to focus on what can happen if it's not transitory, if it continues to chug along and then goes up, or if it pulls back down, for example. Okay, but let me just focus on these 4 points to begin with. The first 2 points down here are things that we know and quite familiar about, and this has been well documented. One, inflation has led to higher commodity prices and input costs. From a company standpoint, it means that my margins, or my gross margins, because gross margins are affected by my cost of raw materials, cost of shipping, etc., that one is going to be narrowed. Then tight labor market, rising wage pressure. I mean, we've seen all kinds of companies talking about this in the last quarter earnings. They're talking about, I mean, McDonald's, for example, has increased their salaries, hourly wages by 20%. That's quite steep. And for them, this is where they're taking a hit at the net profit margin level. So at the end of the day, their margins come down. And if companies' margins come down, what happens? Earnings come down. And when earnings come down, all of a sudden, the valuation for these companies at this level all of a sudden becomes higher, because everything is relative to earnings, sales, etc. The last 2 points down here is also one of the reasons why inflation has been around for a long time, and around maybe not on the consumer price angle, but on the asset price side. So they've got a current stimulus. Obviously, the stimulus is been accelerated and almost doubled, okay, in terms of how it affects the Fed's balance sheet in the last year and a half or 2 years because of the pandemic. But this last point, the multi-year program has been there across 3 Fed chairmen since the GFC. Okay, these 2 points has not affected the stock market or sorry, has not affected consumer pricing or things like CPI and all so much. Okay, I mean, one can say that CPI sometimes they match, they take different elements, but generally, those are the CPI is an indicator the Fed uses when they actually do their interest rates management or yield curve management. But the key thing down here is these 2 points do affect asset prices. Okay, because a lot of people have all this money in the system and they are just committing it to assets including stock market, property, Maseratis, for example. That sort of stuff. Okay, this next chart, I just want to show you perspective. Okay, again, everybody in the market looks at it from a perspective, from a changing point of view rather than absolute number. This is a chart of the yield curve. It's the same yield curve, and the yield curve basically plots the Fed treasury bills or whatever, be it 1 year, 5 years, 10 years, 30 years. Okay, so the curve down here, okay, is basically where the US treasury is at 1 year, where treasury is at 5 years, 10 years, 30 years, or the long bond. The black curve or the black chart or the black line signifies where we are today. The blue line where we were 1 year ago. Okay, what do you see, folks? You probably see that this part has ran away or has sort of steepened. Okay, yeah. And this steepening is for a reason. The market and the market players, this yield curve is a function of how the market players affect in terms of look at the bond market. Has steepened purely because people are factoring, market players are factoring a higher rate of inflation in 5 years' time, in 10 years' time, so on and so forth. And this is actually quite good because they're seeing the economy recovering over that period of time, and they're seeing, with inflation, price pressures will go up for a lot of consumers and for companies. Okay, and this is where we are now. Okay, and this is also whether it's transitory or not, it's also a function of how people believes that the reopening, is happening successfully, especially in the US. Okay, the vaccination rates on there have been incredibly smooth, and obviously it's hit a plateau. But it's given the government enough confidence to reopen the economy, no more masks, go out there and spend, and that will come in to hit the market in a bigger way, and hopefully companies' earnings and consumption will go up. This one is asset inflation, where we are on the NASDAQ. I just wanted to pull this up just to show you. This is over a 5 years period of time. Things have gone up, okay? And this is also a function, even though there was no inflation down here, okay, we are seeing asset inflation actually steepening, and we know this because of the Fed program. And something closer to home, and maybe to Royston, Rolex watches, okay? This is basically over 2019 all the way down to 2020. We have seen everything flatten and then it just went up. Okay, this is asset inflation. Why? Because people got too much money, they buy an AP watch or they buy a Rolex Daytona, and essentially that's where they're committing their money to now. So the key point I want to try to make, and this is where I'm going to, before I hand it over to Royston, is what happens if the Fed is behind the curve. And this is where I think, as we all know, the market got spooked a couple of weeks ago when the word inflation keep coming up and people are saying that, hey, the Fed may be behind the curve and all. Just look at these two steep angles. And this was basically the Fed fund rate, where they were forced because they misread the economy and misread inflation signs, for example, and they went in on a very aggressive rate hike program. Okay, this one was a bit more gradual, 2015, and don't forget this was after 10 years of GFC stimulus, post GFC stimulus, and this basically fueled the stock market in a way that all of us benefited from on asset inflation. This one, when it went up like crazy, okay, this caused certain shocks to the financial systems, including the stock market, and this we know is the GFC. So the point that I'm trying to make before I toss it back to Royston is that whether inflation is transitory or not, it will lead on to other factors. One, if it's going to hit companies' margins, earnings are going to be in question, or rather the rate of growth of is going to be questioned. And if it happens, you're going to see valuations being questioned. Okay. Two, if you are seeing the yield curve continue to steepen, you're probably going to see the Fed being forced to move more aggressively going further out. Granted, the Fed is taking 1, 2, or 3 more readings to see. The question is, will the market be as patient as they are? Okay, and this is where we go on to the next section, which is how do we, how should we prepare for ourselves? And hopefully, I'm keen to see what Royston can share with us here.
Okay,
Royston,
thanks, Nick. But can I have a very quick question to you?
Yes.
Just to summarize, what do you think is the key difference at this point of time in terms of inflationary numbers that we are seeing? Should we be concerned at this point of time compared to, say, a number of years back? And so bottom line is, are you concerned about inflation at this point of time?
Yes, to answer you. Okay. Okay, I'll take 30 seconds. I don't want to take too much. Yes, I am, purely because I don't think the market is prepared. Okay, and yes, I am, because I don't think the market is prepared for what measures need to be done. We can talk, we vented earlier about whether this is transitory or whether this is structural. The structural effect is obviously whether COVID is going to be a long-term effect. If COVID is going to be a long-term effect, then supply chains will always be tight. Okay, the stimulus will always be there. Nobody's going to come out to work. When nobody comes out to work, you're going to see the pressures on the company's margin be even more intense. And when that happens, against valuation, it's going to hit home quite hard. And more importantly, against high valuation right now, of quite a lot of assets, including stock markets, including Maserati car prices, including Rolex watches up. So yes, I am concerned, and I would be very, very, very interested to know how I can prepare myself to hedge, if you call it.
All right. So that comes to my point. Let's talk a little bit about how we can actually potentially hedge using some of the investment asset classes that might be a potential good hedge for the effects of inflation. Okay, so let me just port over to my screen to share with you guys what I actually do have. So just now we were talking about this, which is more like the inflationary impact on consumers in terms of grocery prices. I briefly talk about how to beat inflation. Basically is to invest your money instead of just purely putting it in a savings account. But what I would like to actually showcase is this chart, which I think is quite interesting. So this is actually a information that were being collated by Goldman Sachs previously, actually quite recently, and they actually used data stretching all the way back from 1983 even, to kind of like showcase which are some of these sectors or commodity types that you should be looking at if inflation were to actually take effect in a bigger way. So one interesting component is the sectors, how it actually affects sectors. So the biggest beneficiary in terms of sectorial play will be looking at stocks in the energy sector. So a lot of your oil stocks most likely will potentially be beneficiaries of higher inflationary prices. And some other sectors that might potentially benefit would be IT as well as utilities. But what I find it quite interesting or potentially perplexing could be the fact that consumer staples is actually the sector that will be the most significantly negatively impacted on that front. And some might be wondering why that might be the case. Because theoretically you should be, or consumer staples, companies can actually pass on prices to consumers. We will continue to buy our cornflakes, we will continue to buy some of our toilet paper and stuff like that, right? We'll be rushing to buy toilet paper, in fact. So why is it that consumer staple companies would actually be kind of like negatively impacted? And I think that this data over here actually provides a good summary, which you can see that over here, the blue line, the dark blue line actually shows the PPI versus CPI. So if that line actually appreciates, it basically shows that PPI, which is your producer price index, is actually increasing faster than your consumer price index. And if it actually comes down to negative, that's where the reverse is happening. And you can see of late over here, the fact is that PPI has been appreciating much faster than your consumer price index, which goes to shows that companies' raw materials, their cost of goods and stuff like that, are actually increasing at a much faster rate as compared to them being able to actually increase their product prices to the consumers. That means being able to raise their revenue. So their cost is in fact rising faster than their revenue, and that will ultimately result in margin decline. All right, margin decline.
It's a good chart. Yeah, it's a very good chart.
So that actually could potentially explain in a, I would say, high inflation environment, consumer staples are likely the one that is most significantly impacted. So you should actually be investing into those companies that produces the raw materials as compared to those that actually consumes it. So that's the one of the key takeaways that I have from this chart for you guys. And the next one is actually going into the commodity sectors specifically, which the data is being collated from 83 all the way to 2020. It does showcase that these are some of the potential commodities that you can actually look at to kind of like hedge yourself against inflation. And the most effective one is actually base metal. So products like your copper, steel, aluminum. So these are the ones that is the most effective in terms of hedging when inflation actually starts running higher. And the one that is not so effective are potentially your softer commodities on that fact. But I would say is that base metal as well as energies and precious metal, later we'll talk a little bit more on that as well, are potentially the key ones that you should be looking at. So that in a nutshell, actually provides a good, quick kind of like sectoral focus, which are the key sectors that you should be looking at in terms of inflation environment, and commodity specific, which are the few key areas of commodities that you should be focusing your attention to. And I think that Goldman also provided a very good chart over here, which actually showcases what is going to happen to the returns of the different asset classes if inflation were to be rising. So the light blue bar over here actually showcases if inflation is kind of like in line, but on a rising trend. So which are the ones that tend to benefit? And you can see that most stock markets tend to still generate positive returns on the back of that. But more importantly, it is when inflation is already running high, more than 3%, and it continues to be rising. That is where you're going to see negative impact on a lot of US market, equity markets, and potentially the ones that is really going to be beneficiary, it's your commodities such as oil. This one is your basically commodities being basically the class of commodities that Goldman Sachs actually tracks. And last but not least is also your gold. So these are the top three kind of assets classes that you should be focusing in an inflationary environment.
Wow. So, okay, Royston, just let me interject on here. So what this chart, I mean, and it's good that this chart goes back to, or this table, or this study goes back to 1950, because the more recent ones, basically, I think everything is out of whack. But so what you're saying is that the dark blue chart, high as in more than 3, and this is for the CPI and rising, right? I think the last print that we had on CPI was around 4, it's just slightly above 4, right? So this puts it in that category. Right now, we're going to see that trend. If the next chart comes out or the next read comes out at above 4 or similar to where we were, then I think, I think if this chart holds true, we should all be positioned in oil, commodities, and gold and silver, right?
I think we are probably still in the early stages, potentially still in the early stages if, let's say, inflationary were really to take effect in a much larger way. So not saying that you should be going all into oil stocks or just gold, but definitely it's worthwhile to consider having some of these asset classes as part of your portfolio hedging, in terms to combat inflation. I mean, personally, all along I have at least some gold in my portfolio, like 5-10%, gold as well as gold stocks, gold miners, just for that kind of hedging effect, which is something that I've been quite concerned for quite a while already, but it's only in recent months whereby you're seeing that kind of numbers. Whether that kind of numbers will persist or is it going to be transitory like what the Fed is expecting, I don't know. Nobody can say with certainty at this point of time, but if it does really pans out, then I think there's going to be a lot more legs higher for this kind of asset classes, so to speak.
Okay, no, I understand.
All right, so okay, with that, actually, I have talked about the performance of commodity assets, and most would actually be quite surprised that oil products have actually been one of the best performing asset classes year to date. And the last chart previously, I showed you that today, if inflation is high and continue to rise, oil is the number one asset play that you should be positioned in as well. And so far, on a year-to-date basis, that has been one of the best performing commodity asset classes so far. But you can see on a longer-term horizon, that's where you can see its cyclical nature. It has not been able to beat the stock market on a long-term horizon. All right, it has been outperforming them on a year-to-date, on a 3-month, 6-month basis, and even a 1-year basis. But on a longer horizon, you can see that if you are positioned more in the equities market, that's where potentially you would be winning out. And that actually goes to showcase how cyclical some of these products are, which in the natural sense, it's actually a way to play. I mean, it's potentially a good hedge to play cyclical products, rather than one which is more structural in nature. Because if a product which is more structural in nature, potentially it will not be such a good hedge. And that product might be this commodity called palladium. I'm not sure if you are familiar with this particular asset class called palladium, but if you were to look across its horizon, it is more, I would say, a long-term structural play that over the last 10 years, it has consistently outperformed the stock market, the S&P 500, and not really as cyclical as some of the commodities over here, such as oil, copper, etc. So this is one particular asset class which might not be a good hedge, but is something that is worthwhile looking for those who wants to play the long-term game in terms of this key asset class, palladium, which is used in the automobile industry.
Okay, Weston, just one quick question, okay? So based on this chart, what you're saying is that short term, I mean, based on year-to-date return, oil certainly stands up there, or the oil, I mean, heating oil, gasoline, crude oil, they all seem to be actually outperforming the S&P. But gold, I'm very, very confused as to why it's so far down the bottom also. And that's my first question. Number two, basically there's a short-term thing and there's a long-term thing. I mean, the previous chart, you showed me that in the long term, in the short term, the oils, the commodities, and the precious metal basically tend to outperform and hold itself during inflation. But it's only happened to be a short-term phenomenon, because over down here you see at the right side of the chart, the longer-term effect. The market is still what takes the cake. So if I were to, I mean, just conclude down here, I'm not sure if this is a fair conclusion. If I want to hedge myself against inflation, if I believe that inflation is not transitory, it's going to hit, harder in the next 2-3 months or so, should I be basically trimming down my equity portfolio, especially the NASDAQs and the ones that have done so well, and maybe build a position in some of the oils and some of the even gold for that matter? I'm tempted to go in gold until I saw this.
I think that's a definitive. I think that is potentially a one way, to actually kind of like trim your position in some of these stocks that have performed pretty well, especially growth stocks illustrated by the Nasdaq index, and actually use them or actually kind of like recycle them into some of these commodity plays like oil and copper, corn, etc., which have been proven to be more of a good hedge. Some of the, I mean, as compared to the equity market. I'm also pretty surprised as to why gold and silver has been pretty weak, and some reasoning out there is because gold has lost its position, as the de facto hedging tool after Bitcoin actually comes into play. Whether or not that's true or not, it's still too early to be seen. But what I've read is that recently, increasingly more institutional players are actually flooding back into gold, and you're actually seeing the prices actually slowly appreciating back. So I guess that we are still in the early stages of this inflationary play. It's really going to materialize in a bigger manner, and it's still, I think, pretty early to actually position yourself in silver as well as gold. Some of the precious metal plays, I think.
No, it's I mean, the fact that it's like down, it's an opportunity to buy. I mean, I know some of the gold stocks are actually doing okay. But anyway, keen to see your. I mean, what else do you have?
All right, so I think I'd just like to wrap up on the last point, with regards to some of the other potential asset classes that you might want to be looking at. So this is basically a table that is being highlighted by a Forbes magazine pretty recently, and they actually highlight different types of assets that are actually potential hedges for inflation. Some of the ones that you are probably more familiar with are your TIPS, the bonds, and then commodities that we have talked about. And surprisingly, indebtedness actually ranks pretty high in terms of, being a good inflation hedge. So essentially, if you want to hedge against inflation, just go and borrow money, because at the end of the day, your borrowings will become much, much cheaper. And that's exactly what the US government is doing, right? So
unless they increase the interest rates tremendously,
then you are going to be screwed big time. So you better pray that interest rates remains low. But either way, these are some of the interesting other asset classes that you might want to take a look as well. Lumber producers, that's quite interesting as well. And actually, quite recently, I've actually come across a illustration by Visual Capitalist, which actually goes to show that just across 1 year, the price of lumber have increased by so much that in the past, this amount of lumber can actually build 10 houses, and in today's context, it only allows you to build 2. So
wow, that's a huge impact.
That's the kind of cost inflation that you are seeing in US prices, and I assume that US prices would have to increase according to that, right? They would definitely be passing on the cost to consumers on that part.
I mean, so I mean, to if I can just wrap this part out, it's a very important point. Your example about 10 houses versus 2 houses, for example, for the same dollar value. I think that's very significant, and I think we saw in the last month anyway, a lot of the home builders in the US, your Toll Brothers, your Dr. Horton, so on and so forth, they've all been hit very hard, because I think their margins are definitely going to be under pressure. Yes, they can pass an element around, but that comes to the point where the elasticity of demand essentially don't make sense anymore. So those are things I think we all have to watch out for. I mean, and going ahead, I mean, that's certainly, these are all issues certainly on my radar. And as we go forward, I think we hope to share with you guys a lot more ideas, breaking down some of what we discussed in broad terms.
All right, good. So that pretty much wraps up our kind of like a short sharing session today. So I hope that you guys have actually enjoyed our sharing. Thanks again, Nicholas, for.
Oh, thank you. I really enjoyed myself, and we hope to elaborate on some of these key points so that we can help your audience or your viewers actually zoom in on some of the call to action kind of stories.
Yes, definitely. Appreciate it.
Okay.
All right. Thank you.
Thank you.
Thanks once again.
Bye.
All right. Cheers. Bye-bye.
Yeah, bye.